Just got done editing this interview. You guys are going to love it. Before I do that, though, I want you to know that I'm going to be in the comments for the next 30 minutes or so answering your questions. If there's additional questions you want me to ask the CEO next time I interview them, leave them below. Or if you're just loving the data points I get CEOs to share, click the thumbs up button below. That's your way of telling me you're loving this stuff, and I'll get you more of it. Additionally, again, I'll be in the comments answering any questions you have. All right, for 30 minutes. Enjoy the interview. Hello, everyone. My guest today is Sijbrandij. He's passionate about empowering open source, enabling great products, and evolving global businesses. A self-taught Ruby developer, he commercialized Gitlab with its creator in 2012 and graduated from YC in 2015. Since then, Gitlab has grown to 800 remote team members across 55 countries and raised $188.2 million in funding. Sid, you ready to take us to the top?
For sure.
So I always hate celebrating funding because sometimes it just means a lot of dilution and a big zero at the end. Why'd you need to raise that much money to build the business?
Yeah, I think you shouldn't celebrate funding or like a high people count just by itself. We raised $268 million in our last round at a post-valuation of $2.75 billion. So it was dilutive, but it wasn't too dilutive. And we raised it because we want to make sure that every single part of GitLab gets to maturity. We have the best version control, the best CI on the planet, but we want to make sure that deploying, monitoring, and securing applications, that those parts of GitLab are also best in class.
Now, this round, this was actually you just closed it earlier this month, correct? The 250?
Yes.
And so you had just raised prior to that, I think about 120 million-ish from Goldman and between September and December last year, right?
Yes.
So what's the thinking behind? I mean, when I look at a round like this, right, what I think is, wow, there's a lot of liquidity in the private markets. This is perfect for you. It's better than an IPO. You don't have to worry about all the administrative burden, a roadshow, and all that. It allows you to double down and focus. I mean, do you kind of view this as this was the alternative to an IPO, an easier alternative?
Yes, it could be. Our plan is to become a public company next year. And with this round, we kind of have optionality, whether we're going to do an IPO or a direct listing.
Yep.
So we structured this round with a lot of different investors in it and with a lot of investors that are very familiar in the public markets that are long-term holders.
So just to repeat what you already articulated, you said you raised about 250 and you said it was a 2.7 pre-money valuation? Post money. Okay. So you sold a tad more than 10% of the company.
Exactly.
And did any of it go to the secondary or was all balance sheet?
This is what we're talking about is all primary.
Okay, and that means all to the balance sheet, correct?
Correct.
Have you done anything for early folks that put money in, including early employees in terms of liquidity, or they have to wait until a direct listing or IPO?
We did one at the D round, so the previous round, and we're looking at another one based on this round.
Can you explain how that worked in the D round? There's a lot of CEOs at 60, 70, 80 million in ARR doing these $100 million rounds, and they're never quite sure how to structure the liquidity option for early folks. How did you structure it in your D round to the extent you can share?
Yeah, for sure. We did it with NASDAQ Private Market. It was a great experience. And we said you could sell up to 20% of your vested shares, both current team members and ex-team members. Up to 20%. So people sold between 0 and 20%.
And how did you decide? Was it on NASDAQ or did you do a 409A valuation? How did you come up with essentially the price?
The price was the same as the preferred price of the round.
So this is very rare. I talk to a lot of founders where they get in really weird positions when they do these secondaries because you want the maximum valuation from the round, but then you're going, wait, for employees to make the most on the spread between their exercise price, right? What they got it at many years ago and what they get today, you actually want maybe a different potential valuation for tax purposes. You just kept them both aligned.
So we did, it's market. Like, what does the market want? And the market said, look, there was more demand than there was supply. So it went all the way up to the maximum. It influences the 409A, but it's a one-time event. So it's having continuous trading at that price would influence the 409A way more than a one-time event.
Yep. So of that 120 that you raised in this, well, do you put the 20 from Goldman in December in with the 100 million you did in September or no?
No, that was separate round. Totally, we now raised more than 420 million.
Yeah, because you just did 268 million. But going back to September, what I'm trying to get at, that September 19th.
Oh, sorry. Yeah, those numbers. No, the public numbers, we always try to talk about the primary fundraise, never about the secondary. Because I think if you talk publicly, it's about we raise this money. People are going to assume it's the primary fundraise. And also, that's what people care about. People care about, are you a sustainable company? As in, do you have the money to get to a cash flow break even? That's what you're signaling. So I think it's better to just talk about the amounts in the primary fundraise when you're announcing a fundraise.
What I'm trying to get at, Sid, is how many people decided not to sell versus took some chips off the table. Like how much money from those rounds actually went out from people that did decide to sell?
So all the amounts we announced are all primary fundraises. We're not jumbling the secondary into that.
I see. Okay, so just to be clear, and this is what you're just trying to explain to me, that 468 all went to your balance sheet million you've raised. How did you get the money then? Did you just do it off your balance sheet? Like where'd you get the money from to pay off people that wanted to sell up to 20% of their shares?
Additional investors, mostly investors who participated in the round.
Got it. So NASDAQ
buying even more.
NASDAQ essentially put this out there, and you didn't have to buy them back as a company. Anyone could go purchase those that wanted more upside.
Exactly. So NASDAQ private market facilitates it. It's a bit tricky. Like we had people in over 20 countries participating. So there's a bit of paperwork there. And then we have a couple of investors who said, okay, we want to buy at this price and maximum of this much. They all sign up. The people offer their shares up, and then the transaction closes at a certain point.
Yep, very good. Okay, so just for those of you that might not be familiar with Gitlab, I will tell you we had Sid on prior, and so Sid, last time he came on, this was probably about 18 months ago. You obviously shared you founded the company in 2012, but at that point you were serving about 5,000 customers. What are you up to now today?
So today, GitLab is used in over 100,000 organizations. So we got millions of users. There's 10,000 paying customers. It's an open source project. So there's different versions. And what we do is it's a single application for the DevOps lifecycle. It's everything you need to build software delivered as a single application, all the way from planning what you're going to do to securing that, monitoring and defending that.
And have you seen any patterns in terms of what you're seeing on your average kind of contract value? So when you last came on, you articulated average kind of ACV was around the $20,000 mark across the full base. Has that increased or decreased drastically? I
think we're seeing a major uptick in, like, you're looking at the largest deals, and over the last 3 years, the largest deal kind of gone from 10,000 to 100,000 to now million plus.
You're talking about seats?
Dollars.
Okay, dollars. So just to repeat that back to you, you have many customers paying more than $1 million per year. But if you look at your entire base on average, is the ARPU still about $20,000 a year?
It's about that range, but I think that's
it covers a lot.
It's not a good number to look at. We could easily make that number higher. Just for example, we have a very hybrid sales model, so we do both, like small medium businesses, mid-market, and the enterprise market. The enterprise market is 72% of our ARR, and those are the bigger deals. So what most companies do, they stop selling to the smaller companies. We don't think that is fitting for an open core project. We think we really appreciate smaller businesses also working with GitLab, and that brings your our average revenue per customer down, but I don't think that's a metric we watch. The metric we watch is just incremental ACV and growing that, doubling that. And it's good to look at like the biggest deal sizes and seeing those like growing really, really fast year over year.
Enterprise market makes up 72% of your total ARR. Are you guys in the 200 million, 240 million-ish run rate range today in terms of total ARR?
We're smaller than that.
Okay. When do you think you break 200? Can that happen this year? Is it next year or a year after?
So certainly not this year, and maybe next year.
Feels like a stretch goal or easy to get out next year?
I have to do some, like what we're focused on is not so much ARR, it's incremental ACV. Like it's how much do we add to the ARR? So that those are all the numbers in our heads.
Yep. Let's talk about that then. Yeah. So what are you trying to optimize for there?
Optimizing for growth, and growth in our case, it can be a couple of things. It can be new customer coming in, existing customer expanding seat-wise, so getting more users on the platform, existing customer growing in the tier that they have Gitlab at, like buying a more expensive tier, and of course, reducing gross churn, so making sure that customers renew. Those are kind of the four big components, and then split up between the different kind of types of customers and the different go-to-market motions we have there.
Mm-hmm. Sid, you mentioned last time we were on the show that your gross revenue churn annually was already about 10% or less than 1% a month, which I would say that's already pretty healthy. Have you squeaked out additional efficiencies there? Is it lower than 10% gross revenue churn annually now?
No, gross retention is still about 90%. So that's kept steady.
Okay, and has expansion, so when you look at the not obviously ignore new customer additions, just expansion, right? Revenue has been about what year over year?
Net expansion has been absolutely amazing, and it's way north of 150%. And 150% would already be kind of best in class if you look at public companies. So it's been amazing to see. For example, Goldman Sachs is a customer, and we came in and they said, look, if you're doing really well, in 9 months, we're going to be 1,000 users. And then 2 weeks later, we're 1,500 users. Now they're over 5,000 users. We have a product that makes it so much easier for the developers, the operations people, and the security people in a company that we don't have to push it. As soon as the company says, okay, we allow people to use that, people flock towards it. Every company is like, they have DIY ops, we call it. They put together their own platform from all kinds of solutions that are pretty good by themselves, but the big problem is integrating all of it. If you have an update to your application, you don't want to go to 15 tools and take 2 weeks. You want it done in minutes. And as soon as they open up that to their people, it starts expanding and we get more people in. 2/3 of the net expansion is driven by higher seat count, and we're really proud of that.
What's the other third? Is it a utility-based upsell or?
It's an upsell based on features. We have what we call buyer-based open core model. We have certain features aimed at, for example, executives. And if you want those features, you pay a higher price per user per month.
Interesting. Now, you said last time on the show, your expansion revenue was about 85% on 10% gross revenue churn. So your net revenue retention there was about 175%. I would put that definitely in world class. Are you still at about 175% today?
Yeah, we're now saying we're north of 150%.
I heard you say that. I wanted to push you a little bit harder there, Sid.
Yeah, you heard it. You heard me exactly. We expect the number to come down. So I'm not going to give the number today because we're doing a better and better job at landing a bigger initial deal.
Yep.
So our sales people are getting more experience.
Right?
Yeah, exactly. But it would be a good thing because we're more aligned from the start with the customer. It's more realistic expectations. The number is kind of too high and we want it down. But people regard it as a good number. And anytime a good number comes down, that's seen as something bad.
175, I mean, I would say you are an anomaly, right? I rarely see above 140, right? And I've done 3,000 of these interviews. I mean, 175 would have to come down over time as you get more market share. There's just no way.
We expected it to come down. It hasn't come down yet, but we'll keep trying better at landing that initial deal.
Not a bad statement to make. Talk to me about CAC. When you look at obviously your different cohorts, I don't want to talk on a dollar basis because obviously that will vary widely based off the cohort you're selling in your sales motion. But when you look at the payback period you're optimizing for in each of your cohorts, is there a typical month range that is consistent across all of them?
It's our goal is to make sure that as soon as the customer pays their first invoice, which is like a month or two after we signed the deal, that we get back the customer acquisition costs. So that's like a magic number of 1.0. And I think we've sometimes you hit that, and sometimes you don't. And it really depends if we're in expansion mode with our sales force. Like we're growing, we were kind of behind hiring salespeople. So you hire a lot of extra salespeople, and then it dips below 1.0. And then
because they have to ramp up, they have to get up to quota.
Exactly, they have to ramp up. There's about 8 to 9 months ramp up time where they go from 0 to 100% of quota per month. And
is the kind of average new sales rep that has a quota, is the bookings ARR target north of $1 million?
So average is a really
your new hire in an enterprise cohort.
In enterprise cohort, because we got inside salespeople, etc. So quotas are all the way from 300,000 to 2 million,
based off which cohort they're selling in.
What is their geo? How experienced are they, etc. So we really differentiate there. But yeah, for an enterprise salesperson making like $250,000 or more, it's north of $1 million incremental ACV.
And so is that really what you're optimizing for? If the full OTE is going to be 250,000 base plus commission, you want to see at least 5x that in terms of what the booking target is. So you have 5x salesperson profitability no matter the cohort.
We don't think in it like that. Well, so it will be like 4x to 5x, but we don't think of it like that. What we want to do is we want to pay a competitive wage. We want to make sure we can attract the people we want to attract, and want to make sure that it's realistic. We want our goals to have 80% of our salespeople on 100% or more of quota.
That's good.
So those are the two things.
And how many quota carrying reps are you at now today?
I think native quota carrying, I'd have to look that up. So what you can do is Google GitLab team, and you get to a page that lists our entire team, and you can slice and dice it exactly how you want it. So I see that just now we have 900 team members. This page is like
old,
updated multiple times per day. So
is 900 accurate?
Yes, this is the most accurate number we have. And then I'm going to go to sales, native quota carrying. That's 55 people.
There you go. And how many engineers?
Let's see if we make that assortment. Engineering function is 393 people and 143 vacancies.
There you go. So folks, they're hiring, right? There you go.
We're hiring everywhere. We have over 200 total vacancies.
Yep. Sid, last question I've got for you. Obviously, you're driving incredible growth. The economics make a lot of sense. So you could argue that a lot of burn is a healthy thing for you right now because the economics pan out. But at some point, it does become a little uncomfortable, right? So what's that breaking point for you? I mean, are you comfortable burning, $10 million a month?
I don't think it's about the absolute dollar amount. I think you want to stay on the healthy side of the rule of 40. You want to make sure that your EBITDA combined with your growth rate is north of 40%. We decided last year after the last fundraise to invest heavily in product. We're the leading provider of like a single application DevOps tool. We want to make sure that we capitalize on a giant market opportunity. But I think a year, 2 years from now, we want to stay north of that rule of 40 and keep driving that. We don't have an absolute percentage in mind. And the other thing, of course, is don't run out of cash. So always make sure that you can get back to cash flow break even with the cash you have in the bank. So never depend on a future fundraise.
When you look at your growth rate over the past 12 months, top line, what was that at? Are you guys still at 100% year over year, or no, you're too big to be doing that now?
I think last time we talked, we were closer to 200%. And I think we're at 140 today.
Okay. Now, last time we spoke, and this number I don't think is accurate. I must have captured something inaccurately, but it sounded like you were around $100 million in ARR about a year and a half ago. Was that accurate?
No, that was not accurate.
That was too high.
Yep.
Yeah. Okay, good. All right. So 200% year over year growth from 2017 to 2018, 140% year over year growth 2018 to finishing out 2019 here. So on that growth rate, what you're basically telling me is you're happy and comfortable spending up to, basically negative 100% EBITDA margin, because negative 100 plus 140 puts you above E40, correct?
Yes, and we're not even. That would be the conclusion.
And I'm gonna guess here. You're about to say you're not even close to that. What's the EBITDA margin right now?
I think we're more like working on that longer term. So I don't view it as such. Like we want to make sure that so software is a funny business, and the questions we ask ourselves when we invest is like, are we going to see a return on this investment? The capital is relatively affordable to get right now. Are we going to see a return? And this fiscal, we're spending $50 million in development costs, like engineers shipping more functionality in the product. And our question is, okay, are we going to see a big multiple on that? And so far, the answer seems to be yes. Our customers really need this functionality, and they need it yesterday. So that's our reason for investing in it. And as we come closer to becoming a public company and eventually being one.
Sid, before we wrap up with the famous five, again, you just closed 268 million, right, in your Series E. Was there a general target in terms of you raised that money and you're planning for 18 months of burn or 36 months of burn or 6 months of burn? What time frame were you raising for, would you say?
We raised a round that will be comparable to the amount we would raise if we would go public next year. That was the goal.
Mm-hmm. But what does that mean? I understand that, but what does that mean in terms of runway you're buying yourself to keep driving growth? A year?
I'd like to say infinite runway, because we always make sure we can get back to cash flow break even based on the money we have. So every time we've raised, it wasn't to like make sure we expand our runway. The runway is always infinite. We always make sure we can get back. So every time we raise, it's like, wow, we see a really high multiple on like the features we ship on our R&D investments. So let's raise more money and invest more in R&D. So it's not a runway conversation.
And is the market rewarding you? So if you raise it at $2.6 billion valuation, in terms of valuation multiple on revenue, north of 20x.
Yes.
Very good. All right, Sid, let's wrap up with the famous five. Number one, favorite business book.
Still high output management.
You have good memory. Number two, is there a CEO you're following or studying?
There's so many great CEOs.
Name an off the record one, not a traditional one.
Not a traditional one. Maybe it's not so much off the record, but I think Austin from Lambda School is doing an amazing job.
Yep. Are you an investor?
I'm not, but I gave money to them.
You're hiring? I was going to say you're hiring from them?
No, I gave money to them. I gave $1 million to him.
Just to donate?
Kind of, yeah.
There's no tax benefit for you to doing that? It's just kindness of your heart?
No, well, it's never kindness. What it is I had the same idea for a remote education, but with one twist to it. I think also people should get paid to follow an education, because there's very few people who can forgo 9 months of income. So you should get paid to do Lambda School. And so I'm talking to him, like I said, look, you're doing exactly what I thought I should be, that should exist in the world. And I thought I had to do it. Can you please do the stipends as well? And he's like, well, we need money for that. We need to hire a CFO and need some money kind of to take that risk. I said, okay, I'll supply that money. It will save me a lot of time not having to do that myself. So he did it, and they're now doing that. They're doing more than $2 million in stipends this year.
I love that.
And he's an amazing CEO. So it's great to see that, and it's very exciting to think about what this could mean in the world in generating more income for people.
Yeah, I always say when I'm on these cable stations debating the future of work, and I say, how do you solve student debt? I say it's Lambda School. That's how you solve student debt. It's Lambda School.
Exactly.
Number three, what's your favorite online tool for building your company?
GitLab Pages,
Besides your own,
Slack, Zoom, and Google Docs.
Number four, how many hours of sleep you get every night?
7 to 8.
Okay. And what's your situation? Married, single, kiddos?
Married, no children.
Okay. And how old are you?
40.
40. Last question. What do you wish your 20-year-old self knew?
It's all going to be okay.
Guys, there you have it. Gitlab has raised $468 million last round, $250 million at a $2.7 billion pre-money valuation, more than a 20x multiple on their ARR. This sets them up to either do an IPO or do a direct listing as soon as next year. They also offered obviously secondaries via the Nasdaq private market, where folks could sell up to 20% of their vested shares. But most importantly, they're investing $50 million and pushing additional code to add value to their customers. Now over 10,000 customers, hundreds of thousands of companies, millions of users. Sid, thank you for taking us to the top.
Thank you. And just to be clear, the secondaries, there's no public secondary market for Gitlab, and people are not allowed to sell outside of the people we invite. We're not soliciting any investments, and please don't trade in Gitlab stock until we're public.
Talking like a CEO about to be public. Sid, thanks again.
Thank you.
These CEOs rarely give these kinds of interviews. I hit them hard, I get the data, and I want to do it more. So if you want to get more of this stuff, make sure you subscribe up here. And then additionally, go check out one of my other CEO interviews right now.